Hey guys, Ricky Mike, and today we're talking about the second pillar of how we really invest, and that is looking at balance sheets and whether or not a company is positive or not. So we got a couple good examples too, but why are balance sheets so important and how we select securities?
Yeah, balance sheets are important because when you think about a business, most people focus on earnings, but the balance sheet looks at the asset and liability mix that a business might have. All things equal, we'd like to invest in businesses that are generating strong cash flow, but also have a strong balance sheet. And so, one of the things that we like to look for is a company that, if you look at the cash and short-term marketable securities on the balance sheet, subtract out any long-term debt, is that a positive number? That means that the company is not reliant on capital markets. They don't have to go to the debt markets or raise equity to sustain their operations indefinitely. Provides a high degree of flexibility for the company to navigate downturns, invest in the future, make acquisitions, pay dividends, right? I mean, these are all things as owner of a business that we would want. If a company is negative on that number, meaning they have more debt than cash and short-term marketable securities, it's very important that we look at, what is the credit worthiness of that business? What does the debt maturity schedule look like? One of those bonds that they've issued, maybe one of those coming due. Interest rates have come up, so a company that has a substantial amount of debt might be having to refinance at higher rates. A company that has longer term debt, might have some wiggle room to be able to navigate that. But these are all things that we're looking at when we're.
If you're liking it to individual households, like
Yeah.
houses with a lot of debt, you go through a recession, they're gonna be feeling it more. It's
Great example.
got-
I mean,
you
if
got
you
cash
think
in the books?
it is very relatable, if you're thinking about somebody that they might be a high income earner, but if they have a ton of debt, car loans, credit cards, things like that, they lose their job. The debt payments still have to be made, and so their degree of safety is not very high.
So let's talk Google. Google's kind of had their first rough year in a while. I think they were down 5% yesterday. I don't know what they did today, but Google it's got to be a value stock at this point. It's got so much cash.
No, I actually recently looked at it and compared to, say, the S&P 500, it's trading at almost a 25% discount on many metrics, like price earnings, for instance. But this is a business that we've invested in over the long term, done very well with. We continue to like. It's a great example of a company with a strong balance sheet. As the most recent quarter, $95 billion of cash, short-term marketable securities against $10 billion of debt. So $85 billion, net cash. That's a lot of room for them to invest for future growth. It's just one example.
Yeah. Cash on hand during recessions, they gobble up market share. I mean, Google's a lot more than just search engine these days too. So we can go down the antitrust rabbit hole here. But bottom line is, you're talking balance sheets, Google looks pretty dang good. So thanks. We'll see you soon.